We'll wrap it up. It won't be too long, I promise you. So it depends on how many questions you have for me at the end of it all, but we'll wrap it up with just a brief update on some of the capital gains tax things that have been happening in recent times. The CGT Entrepreneur Relief, they had a go at it in 2013, really didn't get it right. Amended in 2015, and I think they did get it right, but I suspect there might be some changes still need to happen on that, but they, in my view, they did get it right. We look at a couple of revenue e-briefs to do with transfers of trade and withholding tax issues, and then just a brief touch on, as I say, the holdco relief, the Section 626B relief. There's two versions, as I said, of the CGT Entrepreneur Relief. The first was introduced in 2013. And if I can jot down to the last bullet point, it was too cumbersome, too complicated, and from what we can see, there's very little evidence that there was any take-up of the relief at all. Now, it could be argued that it wasn't in place for long enough and that nobody has yet made a disposal of business assets that could benefit from the relief because they've gone and changed it again at this stage. But in any event, just for the benefit of, or for the sake of completeness, just to run through it very, very quickly. What it meant was if somebody made a disposal of asset, any kind of asset that gave rise to a capital gains tax liability, and then reinvested the net proceeds in new business assets, carrying on a new business and a certain type of chargeable business assets, and subsequently disposes of those new chargeable business assets, then any capital gains tax that it becomes payable on the second disposal can be reduced by a maximum of the amount of the capital gains tax paid in the first instance, or 50% of the amount of the gain arising on the second disposal. Now, there were definitions of chargeable business assets, qualifying person, relevant trading activities, all kinds of stuff, and just the way in which the relief was applied meant you basically had to suffer the tax in the first place on some disposal, and you could only then invest the net amount in new business assets. And it was actually encouraging you, to a certain extent, to go and dispose of those business assets in order to get the benefit of the relief from the tax you'd already paid. It really, as I said at the last slide, it never worked. And there was a lot of complaints about it at the time and a lot of submissions about it at the time. I don't think you'll see anybody using it. In 2015, there was a new section introduced, which is a much, much simpler form of relief. And essentially, at its simplest form, if you are a relevant individual, and that's a person who has owned chargeable business assets for the purposes of a business they've been carrying on, and they've owned them for at least 3 years out of the 5 years up to the date of disposal, then the capital gains tax rate that you will pay is 20%. Very simple, very straightforward. You can have that 20% rate of tax on gains of up to €1 million. It's a lifetime limit, though hopefully it will change over time as time goes by. If the total of your gains aggregated over your lifetime exceed the €1 million, then the normal capital gains tax rate of 33% kicks in, but only on the excess. It's not like the retirement relief rules where if you sell an asset for proceeds of up to 750,000, you've no capital gains tax to pay, but if you sell it for €750,001, you're back into normal capital gains tax rules. This is quite different. This is €1 million. It's like an exemption threshold. And 20% is the rate of tax that will be paid on the first million, and then 33% on anything over that. It's a much simpler thing to operate. One issue that does arise in it, which is to do with the disposal of shares in a company that's carrying on a new business and which qualifies as chargeable business assets. The rule is that the individual must have been what's called a qualifying person. And a qualifying person is an employee or director of the company who spends 50% of their time in a managerial or technical capacity in the company. but it's not 50% of your normal working day, which is like the definition of a director, full-time director for retirement relief purposes. The way the legislation is worded, it says, if you spend 50% of the time in the service of that company in a managerial or technical capacity. So if the company is start-up, relatively small, you're only starting to build it up, and it only requires 10 hours a week of your time, provided you can show that 5 hours of that week is spent in a managerial or technical capacity, then you are a relevant person for the purposes of this relief. And when you go to sell the shares in that company, if you've owned them for 3 years, you'll get the 20% rate of tax. It's quite interesting, I think. What the legislation also says is if the other relief, the old relief, would actually, and I'm not sure how, but if it would give you a better result and lower tax liability than this new 20% relief, we'll call it, then you can still avail of the old relief up to the end of 2018. I can't see it happening. I think this will be the one that people will use. Before we go on to that, the point I was making earlier about this is there's nothing in this piece of legislation which says that the disposal of your chargeable business assets, provided you meet all the conditions of owning it for 3 years and it's chargeable business assets and all of that kind of stuff, but provided you meet all those conditions, there's nothing in the legislation which says you can't sell this business to your own company. There's no prohibition for selling to a connected person. So you could sell your business assets, your business as a sole trader, to your own company, forget Section 600 incorporation relief and trying to avoid the tax and all of that kind of stuff, sell it to your own company and pay the 20% rate of tax. So let's say you could legitimately argue that the goodwill of your business is and other assets is worth €1 million, that there's a gain of €1 million on those assets. You sell into the company, you have a gain of €1 million, you pay 200,000 of capital gains tax. Now, yes, I accept you have to have 200,000 to pay the capital gains tax because it has to be paid up front. But you end up in a situation where you now have a debt owed to you by this company for €1 million, which you can draw down over the next whatever number of years with no further tax to pay. You've had a 20% tax rate on €1 million. I doubt it's intended to work in that fashion. Yeah, go ahead.
Does it apply to a share buyback?
Does it apply to a share buyback? It probably does, actually. I hadn't considered that, but again, there's no restriction. It just talks about the rate of tax. Bear with me. I think I printed it off and brought it with me. I did. I'll just read it to you. It says, the rate of capital gains tax chargeable on a chargeable gain accruing in respect of a disposal of chargeable business assets made by a relevant individual shall be 20%. Buyback of shares, if you're a relevant individual because you meet the various conditions, and if the revenue are satisfied that you meet the conditions for the buyback of shares to get capital gains tax treatment, the buyback is a chargeable gain on a disposal of shares. So yeah, it should. In fairness, in the same way as a buyback of shares will benefit from retirement relief, if you get past the first stage, which is get the revenue to agree, buyback of shares rules apply. Once that applies, retirement relief applies. There's no reason why the 20% rate wouldn't apply as well. Okay. I think the trick will be to get the revenue, just to backtrack a little bit, the buyback of shares rules has a crucial test in it. You have to be able to satisfy revenue that the buyback is for the benefit of the trade. Trade benefit test, we refer to it as. If the revenue don't accept that the buyback of shares is for the benefit of the trade, then you're into distribution rules. I suspect with people looking to avail of this 20% rate of tax in order to extract funds out of a company at 20%, there'll be a lot of people trying to argue that it's for the benefit of the trade. And I think the answer from the revenue might be, well, yeah, it's for the benefit of the shareholder, definitely with a 20% rate of tax, but is it for the benefit of the trade? You're going to have to go a little bit further down the line than we currently do, maybe, to have to satisfy revenue, that you're a disgruntled shareholder or you're a retiring founder shareholder that's stepping away and letting the next generation take over and so on. But I could see revenue maybe being a little bit tougher on that question. Section 615 is a device that, it's not a device, it's a piece of legislation that facilitated the transfer of a business undertaking from one company into another company, usually owned by the same people and the same shareholding percentages, perhaps with a view to an onward sale of that part of the business, or it might be just for succession planning. But what it amounted to was a relief that ensured there was no distribution in the hands of the shareholders, there was no capital gains tax issues, and the transfer could take place with no tax implications. Generally speaking, it was good advice to get approval from revenue in advance. What the revenue spotted was a couple of, shall we say, manipulations of Section 617, which is the ordinary group relief provision, and Section 615 together, in order to avoid tax on what would have been, in commercial terms, a straightforward disposal of a business by a company. And if a company is simply selling off a business or business assets, it should be paying capital gains tax in the normal course of events. And I'll go through an example in a moment with you as to how and why, where that would work. But because the revenue saw this as an abuse of the provisions, they introduced a change in the Finance Act 2015, which introduced a bona fide commercial reasons test, and not for the avoidance of tax, into Section 615. And it allows them to examine any kind of a structure to determine whether it's being done purely for tax reasons and not because it's a bona fide commercial transaction. Now, getting into really heavier stuff here to a certain extent, we have this test in a lot of our legislation. Provided you can show that the reason for the transaction is a bona fide commercial reason and it's not for the avoidance of tax, or it's not one of the reasons or the main reason is the avoidance of tax. And that has always been considered to be a single composite test. So if you could demonstrate that, yeah, Joe Bloggs, totally unconnected third party, wants to buy my business, then I could structure it in whatever way I choose in order to minimize the tax. But the driver was, there was a commercial deal there. This guy wants to buy my business. I've agreed to sell it. We've agreed a price. I'm just structuring it in such a way that I don't have to pay as much tax as I might otherwise. So that was a single composite test, and the driver was the commercial reason. There's a risk that the changes that the revenue have introduced here is that they are trying to split that into two separate tests. So that, yeah, there might be a commercial reason for the transaction, but the only reason why I did it in a particular way or structured it in a particular way was to avoid tax. And if you separate that test out into two separate tests, then I would fail the second part of it, and the revenue would have the right, in those circumstances, to deny me the tax relief I'm claiming by structuring it in a particular way, specifically by using Section 615. Now, following the introduction of the legislation in the Finance Act, there were various meetings with revenue at TALC level, and that was certainly the mood from the revenue in TALC, that they were really out to eliminate all possibility of using Section 615, and for all intents and purposes, it was dead in the water. But since the meetings early in January, there have been, that we're aware of anyway, there have been two cases where different districts around the country have confirmed traditional Section 615 reorganisations. So they were done for succession planning reasons, or they were done because there was a sale of a business and the purchaser wanted a clean company, didn't want anything to do with the old company that the business was in. So they gave the approval. So it looks as though revenue may well be softening their approach. And if Section 615 is being used for its intended purpose, it looks like they're going to continue to allow it to be used. Just to put you where where the revenue stood on this, the quote at this part of the slide is what the revenue issued and have put up on their taxes and duties manual to do with Section 615. And in bold type, it said, in relation to 615, it was never intended that the relief would be applicable where, as a result of the section being used as part of a tax avoidance scheme, the CGT charge on the ultimate disposal would be eliminated. No piece of legislation was intended to work in that fashion, if you really read it in that way. But it just demonstrated the approach that the revenue were taking to it, and thankfully that seems to be a little bit softer. But just to give you an example of what was going on here, on the left-hand side is a structure where you had the holding company at the top and a trading company below it, and that trading company had a trade, and they wanted to sell that trade. So if the trading company was going to sell the trade, capital gains tax would arise. So the first thing it did was it transferred the trade down to NewCo, the first NewCo that's set up. And NewCo would owe a debt to the trading company for the trade that had been transferred down to it. Then on the right-hand side, what happened was another NewCo was set up. Now this would not be part of the group because you see there's no direct link from the holdco down to the NewCo. So another new company would be set up, typically by the same shareholders that owned holdco, but not part of the group. And the trade would then be transferred out into NewCo, claiming the reliefs under Section 615. So no capital gains tax, no distribution issues. Sorry, I'll step back one. On the left-hand side, if NewCo was sold, there would be a clawback of the group relief provisions under Section 617. Now, in theory, NewCo could have been held for 12 months and then sold off, and you might get the benefit of Section 626B, but there was still the risk of Section 617 being clawed back anyway. So to get around that, NewCo was set up, the trade was transferred across. So NewCo now has a trade, and the associated debt. NewCo has a trade, but it also has an associated debt equal to the same value, so NewCo is worth €1. So the next part of the transaction was NewCo was then sold off to the eventual purchaser of the trade, who wanted to buy the trade in the first place, for €1. And then the new purchaser put sufficient money into NewCo to allow it to pay off the debt that it owed to the trading company. So the trading company and NewCo 1 are still in a group relationship. Therefore, there has been no break of the group and no clawback of the Section 617 rules. And the trade went out into NewCo 2, which subsequently ended up being sold off for €1. So Section 615 rules weren't breached, and there was no tax liability arose there. And the money ended up coming back into TradeCo by way of the repayment of the loan. So no tax. Revenue, as you can imagine, didn't like it. It was perfectly legal to do it in that fashion, but it was outlawed by putting in this bona fide test and the revenue guidelines relating to Section 615. So that type of thing won't work anymore, but that's the reason why there was the change in Section 615. This is a small thing in the e-briefs. Capital gains tax clearance certificates, as you know, typically apply when somebody is selling property for more than €500,000. The purchaser has to deduct tax unless you get a capital gains tax clearance certificate from the revenue. In the past, that didn't apply to loans, but the revenue changed their attitude back in 2015, and they say if there are loans that are charged on property and those loans are now being sold, which has been happening all over the place, billions worth of loans, then they're saying that yes, capital gains tax clearance certificates are required because those loans that are charged on property represent an interest in land, and any interest in land is deemed to be land for Irish tax purposes. Therefore, it's caught by the withholding tax rules. That's all that e-brief was about. Section 626B is the holdco relief, and this is where a company has a subsidiary, has at least 5% of the shares in the subsidiary, and provided it's a trading subsidiary and the shares have been held for 12 months, then any disposal of the shares in that subsidiary is not liable to capital gains tax. And the problem arises if you've got a subsidiary that you don't own for 12 months, either because there's been reorganizations or you just set it up or for whatever reason, but a purchaser has come along and makes you an offer you can't refuse. So how do you get around it? Well, the rule relating to the 12 months actually has nothing to do with 12 months up to the date of disposal. It's 12 months. You've got to have owned at least 5% of the shares for 12 months in the 24-month period up to the date of disposal. So you sell 95% of the shares and retain 5% until you've got the 12 months period satisfied. Then you sell on the remaining 5% and you get CGT relief under Section 626B on the whole lot, including the 95% that you sold in the first instance, because the total disposal in the year is a disposal of shares in a subsidiary, and you can satisfy the conditions of having met 5% ownership for 12 months in the 24-month period up to the date of disposal. So it's a very simple thing. These are just some of the exclusions where Section 626B doesn't apply. Most people will be reasonably aware of it. The main thing is companies that derive their value from land and buildings do not benefit from Section 626B. Whether it's dealing in, developing land or whatever, if the shares derive their value from land and buildings, even if it's not a property development company, Section 626B doesn't apply. So how does that operate in practice? I've included this because it's not just in relation to Section 626B, but it would also apply in relation to the withholding tax. If you're selling shares in a company and the shares derive the greater part of their value from land or buildings, how do you measure the value of the shares? It also applies for the purposes of a non-resident who's disposing of shares in a company that could have underlying Irish property. So the specified assets rule would apply. And the Revenue have issued precedent on this and stated this repeatedly over the last 10 or 15 years. Their view, and I am inclined to agree with them, their view is that you measure it at the gross assets level. And I'll show you how this example just shows you how that can be advantageous. But you simply look at the total gross assets, and if more than 50% of the gross assets is represented by land and buildings, the shares are deemed to derive their value from land and buildings. The example brings it out very simply. You have an example and the assets are 5 million worth of land and buildings, 6 million worth of other assets. Total value of the gross assets is 11 million. There's liabilities in the business of 3 million, so the net value of that business is 8 million. So if you're measuring the value of the land and buildings as a percentage of the net asset value of the building, of the total company, then the land and buildings would represent 62.5%, and you would fail the test. You would be caught by the test. The shares would be deemed to derive the greater part of their value from land and buildings. But in fact, this is the test that you use. And in that particular example, the buildings only represent 45% of the total value of the gross assets. So that's a company where the shares do not derive the greater part of their value. Now you could have a scenario where this debt is actually related to maybe working capital liabilities or something of that nature, and has nothing to do with those assets. And yet it's still been taken off, if it's been taken off the total value or taken off these, you could end up with getting caught with the rules as well. So simple rule, look at the gross assets. So for 626B, if you're selling a subsidiary company and there are buildings, valuable buildings in the company, that's the test. And you need to determine whether the shares derive more than 50% of their value from the land and buildings. This is something we said we'd raise. It's not on the agenda, but it's something that we said we'd raise. The Companies Act includes a provision which mirrors what happens in a lot of European countries, where instead of having share-for-share transactions or assets being transferred and then a company being wound up, a subsidiary company might simply be, I think the best way to describe it is, subsumed up into the parent company and effectively ceases to exist. And that's what's being proposed in the Companies Act, the domestic merger of companies where one is subsumed into the other. We do not have any legislation in Ireland at the moment, in tax legislation, to deal with this. It is proposed that it will come into effect in 2016. It's possible that you would come across something like that, because the Companies Act is law at the moment, that you would come across something like that at the moment. Our understanding is that you go back to the section 586, 584 type of capital gains tax rules, and essentially what's happening is the shares in one company are being exchanged for shares in the parent company, what will be the surviving company, we'll call it. And the share-for-share rules will apply in the way that they do at the moment, where you just have a share-for-share exchange for an acquisition or amalgamation of two companies. But at the moment, the legislation doesn't exist, and it will be later on this year before it's drafted. So, if I haven't tired you too much, willing to take any questions from the floor. Otherwise, Aisling will forward to all of you, if you put your email on the attendance sheet, Aisling will forward a copy of the slides to you, which will include my contact details and, as I said, my colleague Roisin. And my colleague Jane is also here this evening. I think she's hiding behind the pillar. I haven't been able to see her all evening. Jane's email will be jane.devlin@ie.pwc.com. So if you have any queries, please feel free to come and contact us. As you can imagine, we don't get paid for doing something like this, but we would always hope, sitting in front of a group like you, that you think I'm wonderful, and the next time you have a query, the first thing you're going to do is pick up the phone and ring me because you need some advice. But the reality is that's why we do things like this, and I'd be delighted, if you do have a query, I'd be delighted to sit down with any of you, say for half an hour, see what the issue is. If it's something we can do for you, great. We'll sit down and we'll see what it would cost to do the project with you. If there isn't an issue, I'd gladly give up that half hour, so feel free to pick up the phone and give us a shout. Thanks, guys.